Through the tax management journey, we identify that not all money is taxed the same, and that there's a big difference between tax prep, tax planning, and forward-looking comprehensive tax management. And that those who recognize this and have a strategic plan in place can ensure they maximize their income and minimize their taxes. So let's explore how in the 7-step tax management journey, you can achieve this. Step number 1 is understanding the order of money. There's a specific order to how you should accumulate and save your money when building your wealth. For example, there's an order to how much you should be saving in tax-advantaged accounts like Roth IRAs, tax-deferred accounts like 401ks and IRAs, or post-tax accounts like brokerage accounts. Once you prepare to retire, then, there's an order to how you should take distribution from those accounts. Here we consider 3 things. First, how much you should take from your retirement accounts that will be taxed as ordinary income. Next, how much you should take out of your post-tax accounts that carry preferential tax treatment like capital gains. And then finally, how much you should take out of your tax-favored accounts like Roth IRAs. So often it's a blending of these accounts that will allow you to get the most amount of income while paying the least amount of income tax. Okay, step number 2 is measuring your bracket. The US tax system is a pay-as-you-go system. It's very dynamic. The more money you make, the more income tax you will owe. And you'll also land in higher brackets. So every year, there may be opportunities to take advantage of these brackets. Suppose you haven't filled a bracket in 1 year, and we want to create income all the way to the top of that 12%, for instance. Or in other years, you have a significant income recognition event that pushes you into a higher 32 or 35% bracket. And we want to look at creating deductions to bring you down from those high marginal rates. I'm sure you can see how it would be helpful each year if we proactively measured your bracket, deploy tax management strategies to either increase your income in the 12% bracket, for instance, or decrease your income if you're in one of those higher 35 or 37% brackets. We look at that on an annual basis. We look at managing your bracket, and that is step number 2 in the journey. Step number 3 is avoiding marginal tax traps. These are what I call tax landmines in the code, and you don't want to accidentally trigger them, because although the highest bracket in the code is 37%, the highest marginal rate is almost 50%. That means if we accidentally take the wrong amount of money out of the wrong account, particularly if you're on Social Security, it can trigger one of these attacks where you'll owe 50 cents on the dollar, even though there's no 50% bracket. We had a prospective client last month ask her advisor where she should take money from her accounts. He quickly looked at her accounts, didn't do a proactive tax assessment, sent money from an IRA, causing additional income, which affected her Medicare premiums, her Part D premiums. These are the types of things we want to consider when and how we take money from accounts, and that's step number 3 in the journey. Number 4 is allocating tax-sensitive assets. There are certain investments we want to own in certain account types, meaning there are certain investments that are more efficient from a tax perspective, like tax-deferred retirement accounts, 401ks, IRAs. In contrast, other investment types are much more efficient to own in tax-favored accounts like Roths. And then we also have more efficient accounts like post-tax accounts, where we may qualify for capital gains or qualified dividends, preferred tax treatment. Maybe a step up in basis needs to be considered in these accounts. So it's imperative that we look at the overall household investment structure that we have the right investments in the appropriate accounts. And so if we have two portfolios, portfolio A, portfolio B, the same investments, but we pay attention to what type of accounts are owning those investments, we can improve the total return to either one of those accounts based on an assessment of what investment should be in each account type. So that is step number 4 in the journey. Number 5 in the journey is gifting strategies. There really are 2 prominent types of gifting strategies. First is charitable gifting for our clients who have some sort of charitable inclination and want to be able to provide to organizations they care about. By doing this, we can structure some tax benefits for them. Additionally, there's intra-family gifting as an option. Using this strategy, we might be able to gift money to parents or adult children to help provide support for them while we create some tax savings for us. And then last but not least, there's estate tax planning and gifting around getting money out of the estate for our clients who are fortunate enough to have accumulated enough assets and wealth that they may have a taxable estate position. So we want to be looking at strategies, whether it's charitable or intra-family. This can be a great way to help manage taxes throughout your life. And then on to the next generation. All right, step number 6 in the journey is pay now versus pay later. And at the end of the day, we all have to pay taxes. We never recommend tax avoidance. That is a terrible strategy. However, we all have the ability to decide whether we pay taxes now or later. The benefit of paying now is we know what tax rates are. And sometimes if we defer that tax liability to some unknown point in the future, we don't really know what tax rates could be. Congress and the IRS could change the tax code and tax rates. So there's a little bit of risk to that, perhaps. Do we recognize the income and pay what is known today, or do we take advantage of tax deductions and deferral and kick that liability down to some point in the future? Through our tax management journey, we help you evaluate these decisions throughout every year. Whether you're accumulating wealth, preparing to retire, or are currently retired, we believe a proactive approach to this evaluation will help you maximize your income and minimize your taxes. All right, the final stop on our journey is managing your dynamic bracket. As I mentioned earlier, the United States tax system is a dynamic pay-as-you-go system. When you cross certain thresholds, not only do you pay more tax, but you pay it at higher rates. Every year, there's a chance your income situation will change. If you're still working, maybe you get a pay raise, maybe you have a bonus. Perhaps you have stock options that are vesting. Maybe you have a side business that's producing more income. If you're in retirement, maybe you need additional distributions because you're getting ready to take that family vacation you've been looking so forward to. Every year, your life is changing. Your finances are changing. Your income is changing. And then there's the IRS tax code and how it's ever changing with thousands of pages of different policy and revenue rulings. And it really all comes down to these simple 7 words. Not all money is taxed the same. That statement is definitely something the wealthiest families in this country have figured out. So whether you're still in the accumulation phase, moving into, or are currently in retirement, the more we can engage in a proactive, forward-thinking tax management strategy, the more we can help you keep what's taken so much of your hard work to build. I hope I've shown you how our tax management journey is that proactive, engaging tax management process, which at the end of the day can help you maximize your income and minimize your taxes. If you're interested in how we'd walk through this process with you, please contact us at the information below and set up an introductory call. We really do look forward to hearing from you. Be well.